Imagine living in a country where every bank prints its own money. That was America in the 1800s. Chaotic, confusing, and risky. Farmers and shopkeepers juggled dozens of banknotes, never sure which ones were worth anything. State-run banks made their own rules. The federal government tried twice to create a national bank and failed both times. The first Bank of the United States launched in 1791, pushed by Alexander Hamilton. It brought some order, but critics like Jefferson saw it as favoring wealthy elites. When its charter expired, chaos returned. After the War of 1812, Congress created the second bank, but President Andrew Jackson hated it. He called it undemocratic, vetoed its renewal, and sparked the infamous Bank War. The result? The free banking era, a patchwork of unstable banks and paper notes. Without a central bank, the economy became a roller coaster. Panics hit in 1837, 1873, and 1893. Banks closed overnight. People lost their savings. Nobody, not even the government, could stop the dominoes from falling. Then, in 1907, crisis struck again. A stock market crash triggered a full-blown panic. Only one man, financier J.P. Morgan, stepped in to save the system, lending out millions from his own pocket. That heroism made one thing clear. America needed a real central bank. Enter the secret meeting on Jekyll Island. In 1910, leading bankers and politicians snuck away to draft a plan, mixing American distrust of big power with lessons from European banks. Their blueprint became the foundation for the Federal Reserve. Getting that plan through Congress was a battle. Wall Street wanted control. Progressives demanded public oversight. After years of wrangling, they compromised. 12 regional Federal Reserve banks, overseen by a central board in Washington. In December 1913, President Woodrow Wilson signed the Federal Reserve Act. For the first time, America had a lasting central bank, part public, part private, managing money, rescuing banks, and shaping the economy. The early Fed faced huge challenges. Its job was to keep the currency stable and the banking system strong. Just in time for World War I, the Fed helped finance America's war effort, learning fast about government borrowing and money management. The 1920s roared. Then came the Great Depression. The Fed's failures, like not preventing bank collapses, made the crisis worse. Those scars led to reforms and new powers under FDR's New Deal. After World War II, the Fed got a new mission: keep prices stable and help Americans find jobs. But the 1970s brought stagflation, high inflation, and unemployment. Fed Chair Paul Volcker fought back with sky-high interest rates, taming inflation but causing a sharp recession. In the modern era, leaders like Greenspan, Bernanke, and Powell have faced new storms: stock bubbles, the 2008 crash, even a global pandemic. The Fed now uses powerful tools like buying bonds and setting key interest rates to steer the nation's economy. Today, the Federal Reserve's role sparks fierce debate. Should it be more independent, more democratic? With digital currencies and new challenges ahead, the story of America's central bank is far from over.